All right, so here we are at the last chapter of the book, chapter 15. We're going to talk about corporations in this chapter today and Thursday. So we've got 7 different learning objectives here. We got through partnerships, and I know that was a little bit of a struggle. Corporations have some similarities to partnerships, but also differences from partnerships. So we're gonna go through, and I'll kind of point out some of the things that are similar, some of the things that are different. Actually, more differences probably than similarities. But we're going to talk about corporate formation and the requirements for filing tax returns for corporations. Oh no, we're back to basis. So we will talk about basis again, corporate basis and shareholder basis. So now we're not talking about partners, we're talking about shareholders. Okay, so that's one distinction between partnerships and corporations. Partnerships do not have partners. They have shareholders, and they can have a lot of shareholders, or they can have one shareholder. We're going to look at the calculation for determining taxable income and tax liability for corporations. We're going to look at what the rules are for transactions between the corporation and shareholders. And by that I mean, when we were talking about partnerships, we talked about those, we talked about distributions, we talked about guaranteed payments, different ways that partners can get money or property out of the partnership. So now we're going to look at the rules for when shareholders get money or property out of the corporation. We're going to take a peek at these schedules L, M1, and M3. I won't bother with defining them at this point. We'll take a look at them once we get there. These are schedules that, well, the M1 is used for partnerships as well. And Schedule L is just simply a balance sheet, but we'll take a look at what's involved with those schedules. You don't have to prepare one though, so you got that going for you. Other corporate issues, I can't even remember what's included in that other corporate issues, but we'll talk about that when we get there. And then we have one section on S corporations. So everything in learning objective 1 through 6 here, we're talking about C corporations. And I know, if you recall, I had mentioned that S corporations are kind of like a hybrid between partnerships and C corporations. So if a C corporation and a partnership got married and had a baby, it would be an S corporation. So it's kind of a mix of the two. It's got a lot of similarities of each. It's probably a little bit more like a partnership than it is like a corporation, but we are going to talk about S corporations as well in this chapter. We're not going to go into depth on them, but in fact, S corporations used to be, probably still kind of are, but used to be the most popular business formation. Well, most popular business formation is just a sole proprietorship. But if you're talking about between like partnerships, S corporations, C corporations, S corporations used to be really popular, and everybody was electing to become an S corporation because of the tax advantages of S corporations. Well, when they passed the new tax law in 2017, they significantly lowered the tax rate for C corporations. C corporations used to have, the highest tax rate was 35%, and they lowered it to 21%, and they made it just a flat tax rate of 21%. And S corporations, just like partnerships, are flow-through entities, meaning that the owner of the S corporation who is receiving, and S corporation owners get K1s as well, just like partnerships. I mean, it's the same concept, a different form because it's part of a different tax return, but it's called a K1, and it has like the ordinary income and the flow through items, just like the partnerships do. But people were electing the S corporations because there were certain tax benefits to doing so. But the income was being taxed at their ordinary tax rate, which when the corporate tax rate was, highest tax rate was 35%, that meant that chances are if you were an S corporation, you probably were going to, that income was probably going to be taxed at a lower tax rate than if it was a C corporation. But now that they lowered the tax rate for C corporations, it may make more sense tax-wise for those companies that would have otherwise elected to be taxed as S corporations to instead be taxed as C corporations. But I know that's kind of involved, but just kind of a little inside there into the choices that people had been making with regard to business organization and the changes that resulted as a result of the tax law changes. So anyway, those are our 7 learning objectives here. First thing I want to do, they don't actually mention it here, but I want to pull up the tax form. So now so remember the partnership, we had the 1065 was our tax form. For the C corporation, the form is called an 1120. Okay, so this is the tax form for corporations. You'll see it looks pretty similar, again, to a partnership return. It has a lot of the same sort of stuff. So we've got our income and our deductions here and our taxable income. So again, like an income statement, right? Certain questions that are specific to corporations here, on this Schedule C, and we are going to talk about the first couple of lines here. The dividends received deduction. And then, so we don't have a lot of, well, some of the questions, remember we had that big long list of yes or no questions on the 1065, not quite, well, I guess it's just in a different place. So it's on pages 4 and 5, those yes, no questions. They want information about if other entities or individuals that own more than a certain percentage of the corporation, and you'll see why when we get to, we're going to talk about subsidiaries and brother-sister relationships, so parent-child relationships and brother-sister relationships. And I'm not talking about actual brothers and sisters and parents and children. I'm talking about corporation relationships between each other. You'll understand why those questions are there. So tax computation is there after this, the dividends received deduction, sorry. And then all of our yes or no questions. And then here's our Schedule L. Look, it looks like a balance sheet. It is a balance sheet. So just like on the partnership return, I had a balance sheet. We have a balance sheet here as well. M1, we had this on the partnership return as well. This is our reconciliation between book and tax income. So that's, we're going to talk about a little bit about that. And then let's see, they talked about the M3, which is not actually part of the 1120. It's a separate schedule apparently. So when we get to that part, we'll take a look at those. So this, again, my point being just that it's very similar to a partnership return, very similar as far as, the layout, the types of expenses. The expenses are the same. That whole requirement that the expenses be ordinary, usual, ordinary, and ordinary, necessary, and reasonable applies to corporations as well. That applies throughout the tax code. Nothing special about that, but there are some special, some different tax rules that we are going to cover. There are some special deductions that are only for C corporations, and there are also certain benefits that individuals get that you don't get with a C corporation. So there are some differences there, but this is essentially what that 1120 looks like. All right, I'm going to